Something historic just happened in the silver market, and almost nobody is talking about it. Yesterday, Friday, February 27th, 2026, was first notice day for March silver futures on COMEX. That is the day when traders holding contracts must declare whether they are taking physical delivery of silver or rolling their positions forward. And the numbers that came in are staggering. 10,526 contracts standing for March delivery. That is 52.63 million ounces of silver being demanded against just 86.13 million ounces of registered inventory. Let me say that differently. More than 60% of all the deliverable silver sitting in COMEX vaults was just claimed in a single day. Today is Saturday, February 28th, 2026. Markets are closed. This is your moment to understand what just happened before they reopen on Monday. Stay with me. Let's start with where silver closed this week. As of February 27th, 2026 at 2:32 p.m. Eastern Time, the live silver spot price was $93.87 per ounce. Silver is priced near $94 per ounce, pushing further into record territory as a powerful mix of safe haven flows and surging industrial demand keeps the market pinned near the low 90s. The rally is being driven by tariff and U.S.-Iran risks on the macro side and by AI, data center, and green energy demand on the industrial side. Now look at the trajectory this week alone. On Monday, February 23rd, silver was valued at $86.28 per ounce. By Tuesday, February 24th, silver stood at $87.87 per ounce, a $1.59 increase from the day before. By Wednesday, silver traded at $90.75, up $2.88 from the prior day. By Friday's close, silver was pushing $94. That is roughly a $7.50 move in a single week, almost a 9% gain in 5 trading days. That does not happen in silver markets under normal conditions. These are not normal conditions. Silver's current nominal all-time high is $121.67, set on January 29, 2026. After the historic crash on January 30th, silver dropped to the 70s. It has now recovered more than $20 from those lows in less than a month, and it is accelerating. Gold is confirming the move. Gold stood at $5,226 per ounce as of 9:05 a.m. Eastern on February 27th. That marks a $61 increase from the prior day and a $2,369 jump from a year ago. Gold has not just beaten equities over 2 consecutive years, it has lapped them. Gold above $5,150 per ounce represents an asset that has more than tripled in value since early 2023. The gold-to-silver ratio is currently around 50. That is well below the historical range of 70 to 80. When this ratio compresses, it historically signals that silver is entering a period of aggressive outperformance relative to gold. That is happening right now. Section 2. The COMEX crisis. Now here is the story that should be making headlines but is not. In February 2026, something important happened. Registered silver stocks at COMEX slipped below 90 million ounces. That level matters. It changes how the market looks at physical supply versus paper trading. COMEX registered inventories, the market's most important gauge of readily deliverable metal, have plunged from roughly 346 million ounces in 2020 to recently around 88 million ounces, hitting all-time lows in February 2026. Let me put that in perspective. 5 years ago, there were nearly 4 times more ounces of deliverable silver sitting in COMEX vaults than there are today. The warehouse is draining. Silver inventory on COMEX has dropped 31% since October 2025. Open interest at 230 million ounces versus 88 million in deliverable supply raises delivery sensitivity ahead of March. And here is why yesterday matters so much. Silver closed at $90.10 per ounce on first notice day, as 52.63 million ounces of delivery demand tested 86.13 million ounces of registered inventory, with 74.38 million ounces already delivered in the previous 60 days. Let me break that down in plain English. In the last 2 months alone, nearly 75 million ounces of silver have been physically pulled out of COMEX warehouses. Now, on the very first day of the March delivery cycle, another 52 million ounces have been demanded. The 5,036 contracts delivered in February represent 5 to 8 times historical norms, confirming a behavioral regime change from paper speculation to physical acquisition. COMEX has delivered 86.4% of its current registered inventory in just 60 days. This represents the highest 2-month delivery rate in exchange history. This is not a normal futures market anymore. This is a physical allocation mechanism. Entities are standing for delivery. They want the actual metal, not the paper, not the contract, the silver. Total COMEX silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces in 2025. Every single month in 2025 saw higher deliveries than the same month in 2024, and January 2026 continued the trend. January delivered 49.4 million ounces, 4.17 times January 2025's level, and 7.27 times January 2024. This occurred in a historically minor delivery month, indicating front-running behavior as market participants secured physical silver before March. The question that every silver investor should be asking this weekend is simple. What happens in March if delivery demand exceeds the metal available in the vault? If March 2026 sees even 25% of contracts stand for delivery, COMEX would need 107 million ounces, potentially more than will be available. If the delivery rate matches January-February intensity, we're looking at demands for 200 to 300 million ounces against available inventory of 85 to 103 million ounces. That is the setup, and it just got a lot more real yesterday. Section 3. Wall Street in turmoil. Now let me show you what happened in the stock market this week, because it directly connects to the silver story. U.S. equity markets faced significant downward pressure on Friday, February 27, 2026, as a combination of surprisingly hot inflation data and cooling sentiment toward artificial intelligence heavyweights weighed on investor confidence. The S&P 500 traded down approximately 0.7%, hovering around the 6,908 level. The Nasdaq Composite fell 1.2% to 22,878 as investors rotated out of high-growth software and semiconductor stocks. The Dow Jones Industrial Average was down roughly 0.4%. Market volatility spiked, with the CBOE Volatility Index jumping over 14% to reach 21.35. Stocks dropped on Friday after the latest producer price index data came in much hotter than expected, adding sticky inflation to a list of concerns. The Dow dropped 604 points, or 1.2%. The S&P 500 fell 0.6%, while the Nasdaq Composite lost 1%. All three benchmarks are in the red for February, amid growing fears about the impact of artificial intelligence on specific industries and the overall economy. Nvidia is the poster child for this confusion. Nvidia shares were down nearly 5%. Despite reporting record quarterly revenue of $68.13 billion earlier this week, beating expectations, investors are questioning the sustainability of its current valuation and the broader AI boom. But here is the split in the market that nobody is talking about enough. While Nvidia was selling off, Block was the standout performer of the day, surging 17.8% after CEO Jack Dorsey announced the company would cut its workforce by nearly 40%, or roughly 4,000 jobs, citing the ability of new AI tools to handle tasks previously performed by human staff. And now something bigger is happening. Some investors are gravitating towards sectors that they perceive as less volatile, like utilities and real estate, part of a move toward companies that may be affected least by AI turmoil. Goldman Sachs is now offering a new stock index that tracks S&P 500 companies minus so-called AI enablers. The wide impact of AI is evident because the new index leaves out about 45% of the S&P 500. Barron's noted that investors are embracing halo stocks, defined as heavy assets, low obsolescence. Think fast food chains and auto parts. This is a historic rotation. When Goldman Sachs builds an index specifically designed to exclude AI companies, you know the mood has shifted. Investors are not just nervous about tech, they are repositioning into tangible, hard assets. And what is the hardest of hard assets? Physical metal, physical silver. Bullish investors now account for only a third, 33.2%, of those sampled by AAII, down from a recent high of 44.4%. Contrarians follow sentiment readings because excessive bearishness can signal the market may be poised to bounce. Nearly half of individual investors were bullish as recently as January 14th. Investor confidence is dropping, fear is rising, and when fear rises, money flows into gold and silver. That is exactly what you saw this week. Section 4. The tariff chaos. On top of all of this, the legal and economic landscape in the United States just fundamentally shifted. The Supreme Court struck down a huge chunk of President Donald Trump's far-reaching tariff agenda. The law that undergirds those import duties does not authorize the president to impose tariffs, the majority ruled 6-3. Chief Justice John Roberts delivered the opinion of the court. From January to April 2025, the overall average effective U.S. tariff rate rose from 2.5% to an estimated 27%, the highest level in over a century. After changes, negotiations, and the invalidation of certain tariffs by the Supreme Court, the overall average effective tariff rate was 13.7% in February 2026. Here is what happened next. Within hours of the Supreme Court's decision, the President issued an executive order under Section 122 of the Trade Act of 1974, imposing a 10% tariff for a period of 150 days through July 24, 2026, effective February 24, 2026. On Saturday, he raised the tariff to 15%, the highest rate allowed under this trade law. The Trump tariffs are the largest U.S. tax increase as a percent of GDP since 1993 and amount to an average tax increase per U.S. household of $1,500 in 2026. But here is the part that connects directly to silver. The executive order included a long list of products that are exempt from the 10% Section 122 tariffs, including certain critical minerals, currency metals, and bullion. Silver and gold bullion are exempt. The government is telling you, through its own exemption list, that these metals are different. They are not being treated like normal imports. They are being treated as strategic assets. Now, why does the tariff chaos matter for silver? Because tariffs created the conditions that drove silver to $121 in the first place. In 2025, several events converged to amplify the rally. Tariffs increased uncertainty in the global precious metals supply chain. This led to regional dislocations, shipping delays, and silver being vacuumed from exchanges to be stockpiled in American vaults. Lease rates jumped, temporarily increasing over 30 times from normal levels during periods of acute stress. Even with the Supreme Court striking down the IEEPA tariffs, Section 232 tariffs on steel and aluminum remain at 50%. Under Section 232, Trump raised steel, aluminum, and copper tariffs to 50%. He introduced a 25% tariff on imported cars and a 100% tariff on some pharmaceuticals. The tariff landscape is not calming down, it is reshaping. And every time trade policy shifts, safe haven assets benefit. Section 5. The Mexico wildcard. There is one more supply story that flew under the radar this week, and it could be the most important one for the silver market. According to a CNN report, the recent killing of Jalisco New Generation cartel leader El Mencho by Mexican security forces on Sunday, February 22nd, triggered widespread retaliatory violence across multiple states, including regions with significant silver mining operations. Mexico is the world's largest silver producer. Mexico produced 202.6 million ounces of silver in 2024. That represents roughly 25% of global mine production. If cartel violence disrupts mining operations in key Mexican states, even temporarily, the impact on an already deficit-stricken market would be severe. You cannot replace 200 million ounces of annual production overnight. There is no backup plan. The silver market has been in a supply deficit for the past 6 years, and above-ground stocks are beginning to deplete. Shortages at the exchanges, intense industrial demand, uncertainty from tariffs, and a more liquid, decentralized, and global silver market are defining the current leg of the rally. This is not theoretical. The COMEX data proves it. The Shanghai data proves it. Shanghai silver has been trading at a premium of more than $10 over Western spot prices. That premium signals stronger physical demand relative to supply in Eastern markets. When such divergences appear, they highlight regional demand-supply stress. When the world's biggest producer faces civil instability and the two largest precious metals exchanges are drawing down inventory simultaneously, the word squeeze is not hyperbole, it is arithmetic. Section 6. What happens next? So where does this go from here? Let me lay out what I am watching. March is COMEX's primary delivery month. Historical deliveries in major months typically range from 10 to 20 million ounces. For March 2026, Open interest in the March silver contract represents approximately 500 to 528 million ounces notional. The ratio of paper claims to physical metal has never been more extreme. Elevated paper leverage on physical metal. Paper claims significantly exceed physical availability. Inventory trend is negative. Heavy Metal Stats, an independent COMEX tracking service, shows COMEX registered silver at 86.1 million ounces as of February 26, 2026, and has the silver market rated at stress. On the price forecasting side, the range has never been wider. The 1980 record of $49.45 would adjust to approximately $194 to $200 per ounce in today's dollars. Advocates for silver point to these numbers to justify a price target of $200 per ounce or higher. Most analysts predicted silver would cross $100 in 2026, given its current scarcity exacerbated by geopolitical policies. If $100 is reasonable, what targets are now unreasonable? One comparison point remains helpful: the gold to silver ratio. If gold were $10,000 and the ratio remained 50 to 1, then silver would reach $200. The post-crash recovery tells the real story. Silver crashed 31% in one day on January 30th. The crash triggered forced liquidations in leveraged paper positions, but it redirected rather than eliminated the structural bid for physical metal. Following the crash, iShares SLV Silver ETF saw significant institutional inflows. On a single day in early February, SLV recorded over 1,023 tons, approximately 32.9 million ounces, in inflows, the third largest single-day inflow in the ETF's history. This is not desperation selling. This is opportunistic buying. The bid wasn't broken. The smart money bought the dip. The question is whether you noticed. Section 7. The honest take. I need to be straight with you. Silver is one of the most volatile assets you can own. It dropped 31% in a single day last month. It could do something similar again. If you cannot handle that kind of drawdown, this is not the asset for you. With wholesale prices accelerating, there are growing fears that the central bank may be forced to maintain higher interest rates for longer, or even pause its current easing cycle. The hot PPI data comes just as markets were beginning to price in more aggressive rate cuts for the second half of 2026. If inflation stays sticky and rate cuts get pushed back, that could create headwinds for precious metals. It could also create more economic uncertainty, which is a tailwind. The direction of this market depends on which force is stronger. What is not uncertain is the physical supply situation. COMEX inventories are at all-time lows. Delivery demand is at all-time highs. The market is in its sixth consecutive year of structural deficit. Mexico's mining infrastructure faces new risks, and the AI revolution is creating industrial demand for silver that did not exist 5 years ago. I am not telling you to buy silver. I am not a financial advisor. But I am telling you to pay attention. Because what is happening in COMEX warehouses right now, what happened yesterday on First Notice Day, and what is about to unfold in March 2026 could define this metal for the next decade. To recap, silver closed the week at approximately $94 per ounce, up roughly $8 in 5 trading days. COMEX registered silver is at all-time lows near 86 million ounces. First Notice Day on February 27th saw 52.63 million ounces demanded for March delivery. Gold is above $5,200. The gold-to-silver ratio is at 50, historically signaling aggressive silver outperformance. The stock market is selling off on hot inflation data and AI disruption fears. The Supreme Court struck down Trump's IEEPA tariffs, but he immediately imposed 15% tariffs under Section 122. Mexico's silver supply faces new geopolitical risk, and institutional money is flowing into physical silver, not out of it. March is going to be one of the most important months in the history of the silver market. I will be covering it daily. If this video gave you value, smash the like button. Subscribe so you do not miss a single update. Drop your silver price target for March in the comments. I read every single one. This is your market. Stay sharp. This video is for educational and entertainment purposes only. Nothing presented here is financial, investment, tax, or legal advice. All market data referenced reflects publicly available information as of February 28, 2026. Precious metals are highly volatile investments. Past performance does not guarantee future results. Please consult a qualified financial advisor before making any investment decisions. The creator of this video assumes no liability for financial decisions made based on this content.